Hi there. In a prior video, I talked about why I think that my mathematical intuition is that for digital agencies, choosing to be a C corporation probably doesn't work out from just a rate perspective for you. In most cases, it's still going to be better because of the effects of a double tax to be a flow-through entity for your digital agency. But I want to talk about when it might be beneficial to you, and it's strategically what we look at for other growth businesses, and that is if you actually aren't planning to take any cash out of the business, you're essentially planning to reinvest most or all of the profits of the business back into growth of the enterprise until you ultimately sell it, then the C Corp solution might be better. And in that scenario, because you wouldn't have the double tax, you wouldn't have a tax on any dividends paid to owners, the owners wouldn't be taking any wages, so you don't have any tax there, you don't have any self-employment tax because the owners are not taking any wages. All that you're doing is building the value of the company by plowing the profits back into the company. And so if you're doing that, then the tax applied, the income tax applied to the C corporation is lower than most people's most owners of business, I would say, marginal or effective tax rates. Now, again, it's fact dependent, maybe not, but you're looking at like a 21% federal rate plus your state income tax rate for corporations. So if the combination of those two things is lower than the tax bracket or the effective taxes that the owners of that company pay on their personal returns, then that's it. You have it right there, that the after-tax cash flow that you would have to reinvest in the company will be greater by paying less corporate taxes than if you are in a flow-through entity. But again, the key to this point is that you personally are not actually taking any cash out. You're not taking cash in wages, and you're not taking any cash in distributions. All the profits before paying you as an owner anything are being reinvested in the business. And if that's your strategy with your digital agency to grow it and maybe eventually sell it, then the C Corp solution could be a good solution. The secondary consideration on that, though, is that when you ultimately sell your C corporation, you end up getting stuck with a double tax or the effect of double tax, unless you can make an election for Section 1202 for the sale of stock. So let me talk about what I mean by the double tax on exit first, and then we can talk about the exclusion or the exception for the 1202 stock. If you ultimately sell your C corporation, I would expect that you're either selling the assets from within the corporation or you're selling the stock of the corporation itself to a buyer. If you're selling the assets from within the corporation, then the corporation has gain on selling those assets, which it pays tax on, and then the corporation has a pile of cash. And then you, in wanting to exit this business, take that cash as a distribution. That second transaction is also taxable. So the corporation pays tax on selling the assets, you pay tax on the distribution. So in an asset sale of your business, you will have literally a double tax in a C corporation environment. Okay, but what if you just sell the stock? If you just sell the stock, what happens is that you sell the stock of the business and you pay tax on any gain on the sale of that stock. You personally don't, from an administrative standpoint, remit tax to the government for the sale of the assets because the assets weren't sold. The company itself retained the assets and it was only the stock that was sold. So you might think in that scenario that you escape the double tax effect, but you don't. Or you probably don't, assuming that you sell to any kind of sophisticated buyer, because the buyer gets tagged, or they basically inherit the appreciated gain on the assets inside the company, and there's a deferred tax there that somebody's going to pay someday when those assets are sold or used, and so, or disposed of otherwise. So that buyer is basically inheriting your deferred tax. And they should know that. And assuming they do know that, they're going to reduce the price they pay you for the stock for that deferred tax. So assuming that there's no funny business in the transaction and that the buyer is well aware of the fact that they're inheriting your tax liability on appreciated assets when they take over your company and they buy your stock, they're going to reduce your purchase price for that deferred tax. So you may not see it. You may think that you didn't get double taxed because you don't actually literally see that extra check going to the government. But what you don't realize is that by having structured it as a stock deal, you probably got a lower purchase price for the deferred tax, and so you still got hit with that. So that's classically one of the reasons why you don't really want to structure your business that is appreciating in value as a C corporation. The two things that could mitigate that would be, number one, if you can actually avoid paying tax on the gain of selling the stock, which could happen if you have a Section 1202 stock, then that's great. You don't have two layers of tax in that case, because there's no gain on the sale of the stock. It's excluded. And how would you avoid? And how does 1202 work? Well, the trick to 1202 right now, there's 100% exclusion. We don't know that that'll last forever, so that's one issue. But the second thing is that 1202 doesn't apply to service businesses. So if you're in the digital agency space, you really have to define your business and make sure, and it would have to be true, that your business actually sells digital products, that's the way you contract with customers, and that's how you actually earn your revenue and your sales. And that may be difficult. It may be that you do some of that, but actually you're predominantly a service provider. So 1202 may or may not be available to you. The other thing that can help mitigate this double tax problem on being a C corporation for your digital agency is the concept of personal goodwill. I'll talk about that in another video, but the overall idea there is, if you can claim that the goodwill that grows in the business, which is the customer list and goodwill of the business, is the primary appreciating asset of a digital agency in most cases. And if you can claim that that goodwill does not belong to the company, therefore it's not subject to a double tax when the whole business is sold, but that goodwill actually belongs to the individual owner operators, so it's only taxed to them when the business is sold, then you might get around this double tax problem to some extent with a digital agency that is structured as a C Corp. Okay, well that's it for now, and I will keep talking about digital agency tax strategies in future videos. Thank you.